UK lenders face potential compensation payments over auto finance payments. A monumental decision is on the horizon that could forever change the lives of millions of UK motorists. Imagine finding out that you might be owed a significant payout. The UK Supreme Court, with its 3 esteemed judges, is set to deliver a ruling on Friday concerning the legality of certain hire purchase agreements, potentially deeming them unlawful. At the heart of this matter are commission payments that were discreetly paid to car dealers before 2021, where higher interest rates on loans meant larger commission sums. This controversial practice, known as discretionary commission, was so widespread that almost 99% of roughly 32 million auto finance deals since 2007 included such hidden fees, as pointed out by the Financial Services Authority last year. This situation is reminiscent of past financial scandals, most notably the Payment Protection Insurance (PPI) debacle, where banks ended up paying out tens of billions for mis-selling a product that many consumers neither understood nor needed. In the current case, the lower court of appeal, in a ruling last October, found that 3 motorists who bought their cars before the 2021 ban were not clearly informed that the dealers, acting as credit brokers, would receive commissions for securing loans on their behalf. Critics argue that this lack of transparency has led to unfair practices that could see numerous car owners receiving compensation. However, the story becomes even more intriguing when we consider the positions of the key players. Lenders such as First Rand Bank and Close Brothers have taken the dispute to the Supreme Court, describing the previous decision as an egregious error. Even the Financial Conduct Authority has weighed in, asserting that the lower court's ruling extends too far. Meanwhile, major banks like Lloyd's have prudently set aside substantial sums to cover any potential compensation payouts, reflecting the high stakes involved for the financial services sector. But here's where it gets controversial. If the Supreme Court sides with the claimants, many motorists with car loans taken before 2021 could suddenly be looking at a refund of hidden charges they unknowingly paid, while a ruling in favor of the lenders might dramatically restrict who qualifies for compensation. This isn't just another regulatory fine. It has the potential to reshape consumer rights and banking practices in the auto finance industry. What do you think? Is this a long overdue win for consumer transparency, or are the banks simply being unfairly targeted? Share your thoughts and join the debate on accountability in financial services. UK Supreme Court ruling. Could car finance commissions spark a new multi-billion-pound scandal? The UK is bracing for another multi-billion-pound financial scandal that could rival the infamous PPI mis-selling saga. With a pivotal Supreme Court ruling imminent, lenders face a potential compensation bill eclipsing £30 billion if judges side with consumers in the car finance commission controversy. Here's the deal. For years, customers buying cars might have unknowingly funded secret kickbacks between dealers and finance providers. Friday's landmark decision could upend this industry, but here's where it gets controversial. Should banks be held accountable? Or does the government have a responsibility to shield them? Let's break it down. By end of day Friday, August 1st, the Supreme Court will decide whether car dealers lawfully acted as credit brokers while accepting certain commissions from lenders. 3 test cases, involving South Africa's First Rand and UK-based Close Brothers, challenge whether those payments were disclosed properly. The crux: did consumers give informed consent to these fees, which critics claim artificially inflated loan costs? Underpinning it all, the Financial Conduct Authority, FCA, banned this practice in 2021, but millions of pre-ban loans remain under scrutiny. The stakes? Banks like Lloyd's, who've set aside £1.15 billion, Close Brothers, £295 million, Santander, £165 million, Barclays and Bank of Ireland have these provisions in case claims flood in. Analysts warn this could become the costliest crisis since the £40 billion PPI redress scheme, a scenario that makes even seasoned finance professionals uneasy. but slip into a conversation about government intervention and tensions rise. Reports suggest the Treasury is contemplating changing laws to limit lenders' liabilities, a move some call Bailout 2.0, while others argue it's necessary to prevent financial instability. Here's where things get tricky. Even if the court rules commissions were unfair, the FCA will need weeks to hammer out a compensation plan. Moody's warns the worst-case scenario could hit £30 billion, while RBC Capital's latest estimate suggests around £11 billion. Behind those numbers, over 2 million Brits annually rely on these loans for car purchases. For some, the court's decision might feel like justice. For lenders, a financial black hole. But the ripple effects could spread far beyond car showrooms. If the Supreme Court deems secret commissions inherently unfair, other credit brokers in mortgages, payday loans, and beyond might face similar scrutiny. Imagine finding out your mortgage advisor pocketed thousands from your lender without you knowing. That's the bitter truth for many in this case, and it's making regulators think twice about how brokers operate. As the markets close today and the ruling drops, a key question lingers. Will banks be made to reimburse customers fully? Or will politicians step in with a get-out-of-jail-free card? The answer isn't clear. While the Treasury says it's letting legal processes play out, industry insiders whisper about backroom deals. For consumers, this is about accountability. For lenders, survival. For the UK economy, a delicate balance between fair treatment and market stability. Where do you stand? Should lenders foot the bill for past wrongs, or is government intervention necessary to prevent a credit crunch? Let us know in the comments. The arguments could spark debate for months to come. Reporting and analysis by Sinead Cruz, Ian Withers, editing by Mark Potter et al. Disclaimer: this article reflects the perspectives of Thomson Reuters reporters and editors, adhering strictly to factual reporting standards without bias. Rachel Reeves to overrule Supreme Court on $44 billion car finance scandal. The UK is facing a monumental financial controversy that could reshape the car loan industry, and the government might just override the highest court to protect lenders. Chancellor Rachel Reeves is reportedly considering bypassing a Supreme Court ruling tied to a staggering £44 billion scandal involving car finance commissions. But here's where it gets controversial. This move would essentially rewrite the law retroactively, cutting down billions of pounds lenders might owe in compensation. This revelation comes after intense lobbying by some of the country's largest financial institutions, highlighting the immense pressure on the government from powerful industry voices. The Treasury is currently weighing a contingency plan that would kick in if the Supreme Court upholds the full appeal court decision made last October. That ruling stated borrowers could be entitled to substantial compensation because lenders paid commission to brokers without properly disclosing these fees to consumers. If the law is changed retrospectively, it would mean that past contracts and cases could be altered after the fact, slashing possible compensation liabilities for major lenders, including Lloyds, Santander, Barclays, and Close Brothers. This would be an extraordinary step. Normally, the UK's legal framework relies on common law. In other words, court decisions set the rules rather than Parliament passing new laws. Overruling a Supreme Court decision with retrospective legislation not only challenges the judiciary's authority, but also raises questions about fairness to consumers. If the government goes down this path, it would introduce primary legislation beyond car loans. There are fears this scandal could threaten commission practices across other sectors, everything from appliance to furniture financing. By making new rules retroactive, the government could stop the scandal from spiraling beyond car finance and threatening wider consumer protection issues. Months of lobbying have fueled these discussions, particularly from the Financing Leasing Association, FLA, the industry group representing car lenders, and Lloyds Banking Group, which is deeply exposed due to its Black Horse division. Lloyds alone has earmarked £1.2 billion to cover possible compensation payouts, a clear sign of the financial strain the scandal is causing. Though rarely used, retrospective legislation is not without precedent in the UK. In 2013, the government passed the Job Seekers Back to Work Schemes Act to prevent a £130 million payout to claimants whose benefits were stopped after refusing unpaid private sector work. However, this was justified as protecting public funds rather than corporate profits, making retrospective action to shield financial institutions far more controversial. The government's hesitation is understandable. Overriding a Supreme Court ruling risks the appearance of disrespecting the judicial process, potentially provoking backlash over the separation of powers. Yet, amid growing warnings that the ruling could unleash a compensation tsunami, wreak havoc on the car finance sector, and even cause some lenders to fail, the pressure mounts. The FLA has warned that affirmation of the appeal court decision might disrupt the entire car finance market. This could lead to restricted loan availability, higher costs for consumers, and reduced competition if providers exit the market. From the Treasury's perspective, the scandal is already dampening investment interest and weakening the appeal of UK companies to US investors, a critical issue as London attempts to re-establish itself as a global financial hub. Among affected lenders, Close Brothers, holding about 20% of its portfolio in car loans, has set aside £165 million to absorb losses, halted dividend payments. And earlier in 2025, Reeves attempted a direct intervention in the Supreme Court proceeding, urging justices not to grant consumers a windfall. The Treasury argued for the right to submit evidence, warning that the ruling could inflict serious economic damage. However, the court declined that intervention. Car lenders argue that the appeal court's ruling dramatically raises the standard for disclosure of commission payments and obtaining customer consent, standards that surpassed previous guidelines set by the Financial Conduct Authority, FCA, the city regulator. Moreover, there's anxiety the judgment could spark a wave of complaints across other sectors where brokers receive commissions, unleashing wider repercussions. The Supreme Court heard the case over 3 days in early April, with the final verdict expected on the 1st of August. While the government has so far refused to confirm any plans, a Treasury spokesperson emphasized the need for a balanced judgment that delivers compensation proportionate to losses consumers have suffered, while allowing the motor finance sector to continue supporting millions of motorists. The FLA and Lloyds declined to comment on the situation. This unfolding drama raises an important question. Should a government ever have the authority to retroactively overturn the highest court's decision to protect private industry, potentially at the expense of consumer rights? What does this mean for trust in our legal system and the balance of power between judiciary and legislature? And how should regulators and lawmakers address the complex issue of undisclosed commissions in financial services to prevent future scandals? We'd love to hear your thoughts. Do you think overriding the Supreme Court ruling is a justified move to safeguard the economy? Or a troubling overreach that undermines consumer justice? Join the conversation and let us know your perspective.